Now, fractional reserve bankings by themselves is very constrained because deposits will want to be redeemed by customers of other banks. So if you have your money in one bank, you write a check to your friend banks at another bank, that bank will redeem that check for this bank. So the bank, to stay in business, will always have to maintain reserves to honor those checks. Now, if everyone banked at the same bank, this would not be an issue. If I wrote a check to Mark Thornton and we both banked at Auburn National Bank, my check would just go from my money would go from my account into Mark's account, stay in the same bank. There would be no redemption, and all would be well. So even if there were free banking, that would not be an issue. So the fewer banks you had, with the more customers you have, the more that you can inflate. But the more banks you have with the fewer number of customers, the harder it is. So what was needed to have commercial banking with many banks and still have the apparatus to create money, what you needed was a cartelization system. And that came in the form of the Federal Reserve, which was formed in 1913. And central banks, either government-owned and operated, or else especially privileged by the central government. Of course, you'll run into plenty of people who will say that that our Federal Reserve is private and all would be well if it was just run by the government. But somehow the fact that the Federal Reserve Chairman testifies before Congress, is appointed by the President, I think would seem to tell you that the central bank is there and essentially controlled by the federal government. So the idea that it is private is a misnomer. So how do we create money in a commercial banking system? Hopefully this will show up. Not too bad. You guys in the back are going to want me to shove this up here. All right. So I wanted to pick a big, strong bank to use as an example, so I stumbled onto Citibank. You know how good a shape they're in. And first transaction we have is that the Fed buys treasuries from Citibank. And you can see what happened. See what happens here. There was somebody named Jones that had deposits in Citibanks for $1,000. The Citibank had taken Jones's deposit. They had U.S. government securities of $1,000, but the Fed wanted to expand the money supply and wanted to expand. So what they did was they bought $1,000 worth of bonds from Citibank, and so Citibank has essentially a demand deposit at the Federal Reserve. Federal Reserve has an asset for the government securities that they bought from Citibank. And now Citibank has $1,000 in reserve to lend out. Now, you know, Citi's not just going to sit on that money. They need to find a creditworthy borrower, and you can see that they find Donald Trump to borrow some money. And what we're assuming here is a 10% reserve ratio. So of the $1,000 that that Citi had on deposit with Jones. They lend $900 to Trump, and so what it looks like now is that the assets of Citibank is a loan to Trump for $900. We have a demand deposit still there from Jones because nothing's happened to that. The loan to Trump becomes a demand deposit to Trump. So that totals $1,900, and then the reserves are still there for $1,000. So our T account balances, and we've gone from 1,900 then from 1,000 to 1,900. Now Donald's not a guy that sits on his money very long. He's got bills to pay, and the first bill he's got to pay is to his ex-wife Ivana, but she doesn't bank at Citibank. She banks with the friends of the government over there at Goldman Sachs, and so she writes a check to Ivana, and so now Citibank has a asset in the form of a loan to Trump for $900. They got a demand deposit to Jones for $1,000. Reserves of $100, and then Goldman Sachs, our bank B in this case, has a demand deposit to Ivana for $900 and reserves of $900. Now you can see what it looks like with the Federal Reserve. They've got, still has those U.S. government securities for $1,000. They've got equity and liabilities in demand deposits with now Citibank for $100 and Goldman Sachs for $900. Now, Goldman needs to make a loan because now they've got some deposit money, and they've found a creditworthy borrower in the state of California. And again, using our ratio of holding 10%, they lend 90% of that 900, so 0.9 times 900 equals a loan to the state of California for $810. So our balance sheets now, we have Bank B, Goldman Sachs, got a loan to California, $810. They've got reserves at $900. Demand deposit, Ivana's still got her money there. The state of California now has $810 demand deposit, which is the other side of the loan transaction. So you can see how their balance sheet is expanded. Well, the state of California has bills to pay, and we're going to assume that they have to pay CalPERS. I don't know if you know what CalPERS is, but that's the government employees pension fund that is woefully underfunded, and eventually the taxpayers are going to have to support that, but that's another story. So anyway, the state of California pays CalPERS. We can see what happens here. We've got Bank B, Goldman Sachs. They've got a loan to California, $810, reserves of $90, demand deposit to Ivana still, and CalPERS has their account at Wells Fargo, being a good California company like they are. So this is kind of what we end up with in this particular example. Hopefully you can see that. Oops, got to come down a little bit. There we go. Yeah. Citibank at this point has a Trump loan for $900. They got a reserve for $100. Demand deposit still with Jones. Good old Jones's money. He's been working hard all this time. Goldman Sachs has a loan to California for $110. And reserve of $90, demand deposit with Ivana. She hasn't spent her money on shoes or anything else so far. Wells Fargo now has a demand deposit with CalPERS for $110 and reserves for $110. And you can see what the assets of the Fed now are now treasury securities for $1,000, then demand deposits for $190 and $810 from Citibank, Goldman Sachs, and Wells Fargo, respectively. So this $1,000 that was injected by the Fed by buying that treasury, over time, if we carried this example all the way out, would have increased the money supply by $10,000 or by 10 times. And that's the magic of monetary creation today. And I think hopefully you can understand that if any of those loans go bad, then you create the situation like really what we have today, where you have bad assets in the form of collateralized debt obligations, mortgages, construction loans, land loans. When they go bad on that side of the balance sheet, that's how banks very quickly get in trouble, and then you have people screaming for a bailout of these banks to keep them in operation. The way it leverages on the way up, when the loans go bad, it leverages on the way back down just as quickly. So it is a highly volatile monetary system and could in no way, shape, or form be considered a sound monetary system. Just to bring this somewhat up to date, maybe this spring you read that the Federal Reserve had committed to buying $300 billion in long-term treasuries, and to do it directly from the Treasury. And actually, Murray Rothbard had something to write about this, and I kind of take the situation that he wrote about it and applied the current numbers, but he wrote essentially to the effect that if the Fed were to finance new Treasury bond issues directly, as it was only allowed by law to do for a while during World War II, this step would be highly inflationary. For the Treasury would now have an increased $300 billion, not just of newly created money, but of high-powered bank money, demand deposits at the Fed. Then as the Treasury spent the money, its claims on the Fed would filter down to the private economy, and the total bank reserves would increase by $300 billion. The banking system would then pyramid loans and deposits on top of that by 10 to 1, in our example, and the modern day example, until the money supply increase would be no less than $3 trillion. Hence, we have a highly inflationary nature of direct Fed purchases of new bonds from the Treasury. So when you hear about this in the news, you hear terms like quantitative easing and euphemisms like that, and they make it sound like really nothing very serious is going on. When you hear $300 billion, which I think we're all kind of getting numb to these numbers, to create $3 trillion in money supply is a horrifying prospect. And if we think again, going back to Germany in 1923 and what can happen to a currency, that is really what's at stake here. So what we've done is we've gone from barter, we've gone to this being $20, now this is $20, and who knows what it'll be in the future. But essentially, with fiat paper and multiple fractional reserve banking and central banking, we now have permanent inflation. Thanks.